All right, let's talk about buying the dip. But we're not just talking about scooping up shares of stock. No, today we're going to dig into a really powerful options tool called leap calls, and we'll focus on how you might use them with the big S&P 500 ETF, SPY. So, let's get right into it.
Okay, picture this. The market takes a nosedive. All the headlines are screaming doom and gloom. You look at your portfolio, and it's just a sea of red. Now, your first instinct? Yeah, it's probably a little bit of fear. But if you're thinking long term, you've got to ask yourself a different question. Is this the time to panic? Or is this the opportunity I've been waiting for?
And look, this isn't just some hypothetical. Let's put a real date on it. Let's say it's January 20th, 2026. The S&P 500 ETF, SPY, gets absolutely hammered. We're talking a drop of 2.1%, closing right around $677 a share. And the reason? A bunch of scary headlines about new tariffs. That is the kind of day that really gets your heart racing. So, what's the big deal? Well, what's really happening here is the market is just reacting to fear, pure and simple. You get a policy shock like this tariff news, and boom, everybody hits the sell button. It's a total knee-jerk reaction. But that reaction, it creates volatility. And it's exactly in these moments when everyone else is freaking out that strategic investors start paying very close attention. And that brings us to the real million-dollar question, right? If you're looking at this whole mess and thinking, you know what? This is just noise. The market's going to be higher in a year or two. Well, what's your move? What is the smartest way to actually act on that belief and position yourself for the recovery you see coming?
Well, one possible answer, and the one we're going to break down right now, involves a special financial tool known as a leap call. Honestly, it's a tool that's almost tailor-made for this exact kind of situation, when you have long-term confidence, even when things look pretty shaky right now.
Okay, so what on earth is a leap call? Well, LEAP is just a fancy acronym. Just think of it as a call option, but on a really, really long timeline. You know how a regular call option gives you the right, but not the obligation, to buy 100 shares at a set price? This is the same deal, but the key difference, the big one, is that these things don't expire for a long time. We're talking more than a year away, which gives your big idea plenty of runway to take off.
And I'm not kidding when I say long-term. For a big ETF like SPY, you can find options expiring a year from now, 2 years, sometimes even 3 years out. And that long horizon is what makes them a totally different beast from those risky short-term weekly options that you might hear people gambling on. So why is this so powerful? Well, here's the magic. To buy 100 shares of SPY at these prices, you need a boatload of cash, almost $70,000. But a leap call, it lets you control those exact same 100 shares for a tiny fraction of that cost. That's leverage. And maybe the best part, your risk is capped. The absolute most you can possibly lose is what you paid for the option up front. That's it. So you get all that juicy upside exposure, but with way less capital and a hard stop on your potential losses. So let's put it all together. The whole strategy, the core idea, is to use that fear in the market, that dip, as your perfect entry point. You're using it to get in and apply this really capital-efficient leverage to bet on a long-term recovery. But why is a dip like this such a golden opportunity? Well, a few reasons. First, history. Markets have a pretty good track record of bouncing back from these kinds of shocks. Second, just look at the long-term trend of the S&P 500. It generally goes up and to the right. And third, there's a more technical reason. When fear spikes, option prices, what we call implied volatility, or IV, they go through the roof. Now, that makes short-term options crazy expensive, but the effect isn't nearly as bad for these long-term leaps. So they become kind of like the better deal on the shelf. And this quote just nails the whole mindset, doesn't it? You're literally using everyone else's short-term panic to buy a ticket for the long-term recovery, and you're potentially getting it on sale. Okay, enough theory, let's get our hands dirty. Let's walk through a real-world, step-by-step example of what this trade might actually look like. So here's the setup again. The market just got walloped, down over 2%. SPY is trading at about $678. You're looking out over the next year, and you're bullish. So what's the play? All right, here's one possible move. You buy a call option that expires about a year from now. We're going to pick a strike price of $650. Now, since SPY is already trading higher than that, our option is what's called in the money. It already has some real built-in value. The price tag for this option, the premium, is around $70, which, since options control 100 shares, comes out to $7,000 total. Now for the important part, your break-even. You just add the strike price and the premium.
So you'd need SPY to get above $720 by expiration to be in the green. Okay, but what about the fun part, the payoff? Let's say you're right. Let's say the SPY just rips higher and hits $800 by expiration. Well, your option would then be worth about $15,000. You subtract the $7,000 you paid for it, and what are you left with? A cool $8,000 profit. That is more than a 100% return on your initial capital. That is the power of leverage we've been talking about. And this is a huge but, so please listen up. This is not a bet the farm kind of deal. High rewards always come with high risk. The absolute #1 rule here is to manage your position size. We're talking risking only a tiny sliver of your portfolio, like 1 to 5%, on any single trade like this. Seriously. Which, naturally, brings us to maybe the most important part of this whole conversation, all the ways this can go wrong. Because trust me, there is absolutely no guarantee this will work. So what are the big risks? Well, for starters, there's time decay. Think of your option like a melting ice cube. Every single day that ticks by, it loses a tiny bit of its value. Drip, drip, drip. And if that dip you bought turns into a full-blown prolonged bear market, whoosh, your option's value is going to plummet. Heck, even if the market just goes flat and does nothing, that ice cube is still going to be melting. Oh, and one more thing. You don't get paid any dividends. Those go to the actual shareholders, not you. So at the end of the day, it all boils down to one simple question you have to ask yourself. You've got the potential for these huge leveraged gains on one side and all of these very real risks on the other. The real decider here is your own conviction. How strongly do you really believe in that long-term recovery? Is that belief strong enough to make these risks worth taking? So where does that leave us? When the market drops, are these leap calls a brilliant strategic tool? Or are they just a fancy way to gamble? You know, the truth is, the answer isn't in the tool itself. It's in the person using it. It all comes down to your research, how you manage your risk, and ultimately,